Welcome, and thanks for listening to this special conversation. Your host is Aaron Schindler, a certified financial planner with Osaic Wealth, and today's guest is Sharon O'Halloran, a world-renowned political economist from Columbia University who is currently guest lecturing at Trinity in Dublin. Stay tuned after the episode to get to know more about Sharon and Aaron, as well as how to contact Aaron if you have any questions.
Sharon, welcome. What a difference a day makes, as I've said to you. We got opportunities in Defiance and in Dips. So I wanted to speak with you as one of the brightest minds I know. You are one of the brightest political economists I've known for years. And I'm very thankful that you're joining today. Let's talk about tariffs and politics. Most people don't really know what tariffs are. So why don't you give us a little bit of definition there?
Tariffs are a tax, plain and simple. They're a tax on goods and services that come into a country from another country. They are usually a percentage of the value of a good.
And then something interesting. Tell us about 1913.
The 1913 was the first time they introduced the income tax. Prior to that, tariffs were the primary source of revenue for the federal government. Tariffs have always been both a political economy discussion about interest groups, pressures, and protectionism, but they're also part of public finance, and therefore have a central dynamic in the political economy of U.S. history, as well as part of the current debate.
And public finance, traffic lights, roads, potholes.
How do you finance those projects? The political economy is what's the return on those projects? And then it's how do you finance that? And that's a government discussion about raising taxes. Tariffs are a way to raise taxes.
I like the idea of reducing government expenditures, but I don't like the idea of all the political funding. Any thoughts about that?
To the extent that you believe government institutions and regulations can fill market failures, places where markets are incomplete, and that it's important to have different types of regulations, whether it be environment or different types of market exchanges, then it's important to have government oversight and participation in those markets. To the extent that you believe it creates inefficiencies is the extent to which you might want to mitigate that types of influence. It is clear that the Trump administration and the participants of the Dodge
Dodgeball,
have a very strong view that government creates inefficiencies as opposed to solve problems.
Okay.
And therefore, they see this as the only way to eliminate those inefficiencies is to eliminate much of what government does.
I think it's important to understand.
Here's our tax.
So it means that different countries for different goods are paying a tax.
So for us to import that,
think about the clothing we're wearing.
There's a tax that an exporter has to pay for coming into the U.S. Though that is whoever is buying that product from abroad is going to face the price of a good plus that tax. The government gets that tax. It goes to the treasury. The person has to gets the product, and they either they sell it to consumers, or or a distributor. The price that someone sees, then as a consumer, will be the price plus the tax that's there, not including sales tax or local taxes that happen when you buy that.
So
prices will go up.
Right. So Sharon, prices will go up.
Prices have to go up. Prices will go up unless the producer or the distributor absorbs those. And that will have to do with the elasticity of demands and so forth. But most likely, as we've seen in Trump 1, most of those price increases from tariffs were actually passed on to consumers.
Okay. So now I guess we're in this tit for tat.
Right.
Tariff war. particularly with China. I was going to ask you actually, where's the tariff money actually go? But we'll get to that, right? But this tit for tat war, particularly with China, right? And then, so is this inflationary or recessionary?
So there is a direct positive correlation between tariffs and inflation. Inflation doesn't lead to tariffs, but tariffs lead to inflation. And therefore, it's going to be hard to say that by imposing these tariffs, you're not going to see price increases at the consumer, either by consumer price index or in the producer price index. They're going to come out that way, however you measure.
Right.
Everything that is being imported will face those tariffs and will be more expensive, correct?
Right. And I think they already are. I think that when you look at the price of a gallon of gas, it's always been passed on even before anything really happened.
Because the margins are usually so small in gas stations, they have to.
Oh, I didn't know that. Yeah. Okay. So now we talk about our pockets, our wallets, our wealth. This is catered to my clients, and
Right.
talk about the stock market. And what another tip a day makes.
Yeah.
You talked about CPI, you talked about PPI, and let's talk about consumer sentiment, right? Are we in trouble or are we predicting trouble? I look at fear, the gauge of fear, consumer sentiment.
So,
and stocks, our portfolios.
yes. So I think it's important to realize that a lot of this sentiment is being driven by the enormous amount of uncertainty that the policies that the Trump administration are introducing is creating. It's creating both for consumers, whether they can afford that house or buy that new car, for investors, whether they really believe that the companies that they're investing will maintain those profits if their input prices go up, and for foreign investors, whether they should be holding U.S. bonds, predict price and make good evaluations of something going forward. And it's very hard for people to do that when things are uncertain. People can manage risk, but uncertainty is very difficult because you don't know what you don't know. And I think that's the environment in which people are in.
Right. That we're all trying to navigate.
Exactly.
Right. And, we have to use our phones. We may not be buying a new phone, but we're going to pay our monthly phone bills, right? We might not get a new car so quickly, but we're going to replace if our washer or dryer, right, goes debunked.
Well, I'm definitely replacing my washer and dryer.
There you go. There are companies that will continue to do well, and also their dividends, right? I mean, get paid to wait. The question really is, Sharon, how long are we going to wait for clarity?
Clarity is going to be forced on it when people are no longer willing to hold debt. At that point,
It's a huge statement.
that is a big statement, because either the sovereign debt and the large investment banks have had to rotate out to cut their losses and now have to reevaluate their entire portfolios, or enough damage has been done to the credibility of the U.S. dollar and commitment to different types of policies.
The full faith and credit.
That's right. The full faith and credit that people are going to be less willing to hold dollars. And once that happens, that's going to give us enormous clarity. That's not a clarity that we necessarily want, but that would be the final end game. In the interim, there's a lot of wiggle room consistent with the Trump administration's policies and goals that will allow us to navigate this. First of all,
talk about exemptions.
what we're seeing on exemptions of the tariffs is a lot of large countries are being able to negotiate exemptions for their particular products, imports. Apple doesn't produce anything. It's a design company that outsources all its production to a very efficient and complex supply chain all over the world. Therefore, for them, they have to be able to have an exemption, or Apple products would just be exorbitant. and they just won't be able to make a profit. They just won't be able to sell.
They have an exemption.
They got an exemption. Another company like Nike would be a prime for those types of exemptions as well. But they're going to be very large companies, and they're going to be large companies that have a lot of political clout.
We don't have to go barefoot.
As long as you buy Nike.
I have to bring some levity to this,
But those will be the places where we'll see those types of exemptions taking place. But there'll be lots of other small to medium-sized firms who buy inputs or product to make their final product that will be subject to increase in the cost of their production process simply because of those tariffs, able to get the attention of the Trump administration to get exemption. And those, I think, are going to be some of the hardest hit sectors of the economy.
And I don't think I may not have told you about this, but I work out in the gym, and one of the other trainers, besides my trainer, Nick, their clients have gotten to know. One of them provides poop bags to parks departments all over the country. So when you go to Riverside Park, Central Park with your dog, and you got to pick up the poop, she and her husband provide the poop bags. Where are they manufactured? China. But they have another source, thankfully, in the U.S. Their margins are going to go down, but at least they can, temporarily, they're negotiating.
So you may see some shift in purchasing from foreign sources to domestic sources. And because of the tariff, those domestic producers may become more profitable, right? They may get a larger market share. But when you do that, you are not necessarily using what we would like countries, people, and firms to do, their comparative advantage, taking advantage of what they do really well. So in that sense, then, because we're not going to be taking advantages of those efficiencies, the costs and the production and our factors will be sort of put to inefficient use. So we're leaving a lot on the table when we make those shifts from highly efficient, low-cost producers to more expensive producers. Maybe the domestic producers are better quality, but it's a difference.
So that brings up an interesting point about kind of the evolution of economies of scale, right? It wasn't done without thought to outsource production to countries with cheaper labor, like China and Vietnam and Bangladesh.
It was absolutely done mindful of two things: the costs, the labor costs, the skills, that are productivity skills, and the availability of capital to be able to put in plants, as well as regulatory environments and other types of incentives. So those packages and the way companies are sophisticated in thinking about where parts of their product are produced is done with all of those elements in mind.
Tell us about Mexico and Canada.
Mexico and Canada, part of the North American Free Trade Agreement, was subsequently under Trump renegotiated to get better terms for U.S. producers, predominantly in the domestic rules of origin. That is, not allowing other countries to ship to Mexico and then Mexico ship it like a Mexican product to the U.S. to make sure that shores up, especially for the auto industry. What we're seeing is that firms used that benefit to move their production to Mexico or Canada, at least parts of it, and then allow for different parts of assembly. GM goes back up to where they finish up the touches and put on all of the add-ons to have the highest value added, and then sell it as a U.S. product. That gives them a very efficient way to use relatively low-cost labor, but have these skills, and they use it so that they're getting the highest productivity out of each of those labors. Remember, if you have really cheap labor, but they're not very productive, it's not cheaper than just doing it in the U.S., where you may have higher cost labor, but they're more productive. So you balance out where everybody's good at producing what they're really good at and take advantage of those efficiencies.
So let's just get back to this argument, valid nor not valid fair nor unfair, is this concept that, okay, tariffs is going to bring manufacturing back to America. Does that make any sense? What you're saying is it doesn't.
First of all, not in the way where you had in the 1950s, 60s, and 70s. It doesn't look like that. A lot of these works are now automated. A lot of the skills that robots were possible. I mean, robots can't do everything, but robots can do welding and steel pressing and all of those other things that are part of producing a car or other types of steel and so forth. They're not good at specialty products. And so what you need then is, if you're trying to bring them back onshore, you need to have a labor market that meet the skills, as well as invest in huge plants, right? Reinvest all of that capital into the U.S. It actually takes a lot of investment to bring all of that production back onshore, not only having the right type of labor, but also the right type of capital to produce efficiently.
And what about time?
It's a retooling. If you remember Chrysler, GM, retooling to be competitive took them quite a number of years. In the 1980s, when they were competing with Japan, they weren't able to compete on the low compact markets. So they looked for voluntary export restraints by Japan. They tried to negotiate quotas. They tried to negotiate different things that would allow them to have the capacity to rebuild their capital stock so they could be efficient in the global market.
Good Jewish boy having Easter lunch with friends. She just came back from Japan. She said they had a loudspeaker public apology if their high-speed train was late 20 seconds.
Yeah.
Yeah. So
it's not like we've been constantly apologizing.
Well, I know that might cause some anxiety, but when we go back to portfolios, right? Yeah. And we go back to whatever crises we ultimately have, could be debt crises. And you alluded a bit to the US dollar and this tit for tat trade war. China is the largest investor in the US treasuries. Then we have Japan. Then we have Great Britain. Last time I chatted with you, you're in Dublin at Trinity. So you have that European view too. But it's not in their interests. It's really not. If I already own treasuries of different lengths, different maturities, 10 years, 30 years, it's not in my interest to rattle treasuries.
Right. No, I agree. What they'll do is they'll just roll them off. They're all staggered. There may not be renewing those, buying them back in. Especially you have Europe talking about to what extent it's in its interest to become a reserve currency. And
the dollar.
No, the euro. The euro, which is basically a basket of goods of 28 countries, right? If you look at the affiliates and everything, to the extent to which that can be grown and expanded, right? To what extent would the euro be a more preferable or stable reserve currency?
That's a discussion.
That is a discussion.
I manage portfolios. I manage $100 million. And I just this year went with the old axiom of valuation, right? So we're more in value, right? With lower price to earnings ratios than sticking with, the magnificent seven, right? Amazon, right? And
Microsoft,
and Microsoft and the various big tech. But that we entered this year, 2025, with PEs over 30. Price to earnings ratio over 30. We entered the year with PEs of Verizon and AT&T and so on at around 12.
Mm-hmm.
Right? So forgetting about the geopolitical field, the norm would be to rotate from overvalued equities to what we see as value with dividends, right? AT&T, 5%, 4% dividend, depending on when you bought it. So we're not doing too badly. Now you're talking about investing in euros, but Europe's not the most efficient marketplace either. So where do we go?
Well,
Money to be made.
lots of people making money in the volatility, correct?
Yeah.
But there's also money to be made where you look at, if you believe the tariffs go into effect and that there'll be an increase in prices, which will then lead to companies, and firm and consumers to buy less of particular
Well,
products.
that's called a recession.
Well, a slowdown in economic activity,
Right.
then you would anticipate that there may be some slowdown in hiring as well. Not that will be large unemployment, but in fact, there would just be a slowdown in replacing people and normal attrition and those types of things. So my sense is if you believe that's the scenario we're entering into, then in fact, you would rotate into consumer types of goods that people have to buy.
Not the stapler.
Well, you could, but it'll be goods that are inelastic. The washing machine, the dishwasher. If one goes, you have to buy it. Car parts to keep that old clunker going. Those are the cases where you would look to make sure they will continue to at least have some profit. Those companies should be stable through this period. Wholesale, low-cost producers of like wholesale or should do well during these
Or
periods.
Costco or
A Costco or Sam's or Walmart, all of those, they're becoming incredibly are pretty similar and very competitive in pricing. I think those are the types of places where you see the best or at least maintain value in these periods.
What do we call it? Ethereal staples, like mining?
Well, again, right. So there are certain things that you need, right? Batteries, for example, those obviously there's at least a set market that it can only go down so much because there's a certain population, certain percentage of that population needs to have a mobile phone. Those mobile phones need so many batteries. So you could figure out the average demand. In those sense, then there is a consistent demand. However, it won't be for new batteries necessarily like for new phones or any of the other sort of state-of-the-art next-gen batteries that are coming.
The next series.
Exactly. So those are places to look as well to maintain value. In this period, your goal is to really maintain value, get dividend returns. If you look at those companies and those types of portfolio,
You get as long as they can maintain the dividend and their cash flow.
Cash is starting to look good again, right? Because
that depends where rates go, right? I mean, is it? And now you're making me think: do I need to put money into the bond?
I would diversify my currency holdings. I guess if you're worried about the dollar right now.
Let's do that as a almost final topic here. Yeah. I mean, Trump is trying to deflate
the dollar. Yes, he is. And he's doing a good job with all that uncertainty. And that makes our exports relative to, right. You would expect then that should offset demand as long as nobody else increases tariffs on us. Right.
Right. So then you have, right. So here's what is hard to grapple with. I get make exports cheaper. Companies that export product should do better. But when does this tit for tat stop? The hardest thing about investing money right now is tomorrow there could be hundreds of more exemptions or a deal could be made with China.
Most likely with Europe first. I would say Europe first.
And then the market flies up. I mean, it's just hard to tell.
That's the volatility issue. If you're worried about the exchange rate, you want to level that out because then it could go down by 10% in a day, which is we're seeing it going up by 10% in a day just the last couple of.
And I was going to buy the tech index on the dip on that last dip, but I missed it because it didn't dip as far as I thought it would go. I know that's not what one should not wish for dips, but But
Well, it's getting there, I bet
Money
now.
was-
And look, after today, you might want to check that out.
yeah, yeah. So, that's how we ultimately make money.
You could just play the VIX, right? If you want a lottery,
Right.
from Vegas,
Yeah. Hey, volatility, right?
good. Edit that out.
Wait, you're right. It's not my kitty. So, but ultimately, all right, here's the last question. Opportunity, doom, where are we going? That pendulum.
So the way these usually work, these events, we'll call it event predictions, right?
It's called economist events.
Exactly. These political economy events are that they're done with creates a shock. And then in that case, what you're seeing is that there's two ways to resolve these things. Either you get into this tit for tat, as we're seeing very aggressively between the US and China, or what you're seeing between Canada, Mexico, and Europe is an attempt to negotiate a better win-win scenario.
Right. For the US and those so-called
partners. Nobody wants to see the dollar not be the reserved currency. It's very expensive in some ways to be a reserve currency, and it would be very hard for Europe to be the reserve currency because it has to have everybody align their budgets. And that's just very hard as opposed to one country. I'm letting you know about a coordination problem. I'm not making a statement about the market maker. I'm giving you information.
Yeah.
And in this case, then, it's not in anybody's interests because each of these countries have sovereign wealth funds, all of which have lots of dollars in them. So it's not in their interest to see that take place. And voters in this, yes. So that's one reason why you're going to see that take place. Negotiating strategy. So what you're going to see, even though they're going to go for, they'll say, yes, well, if you do this, we'll do this. That's a way to get people to the negotiating table to see what can be pounded out and find common agreement on it. That's the best case scenario for Europe, Canada, Mexico, and the US. On China, it has a lot to do with positioning and power, market power between the two countries. And therefore, it's going to be a much harder path to come up with a coordinated agreement over a large range of issues. However, it's still in people's interest to find some commonality there because, again, Asia is a very large market. The U.S. has a lot of investment in China, Vietnam, Japan, other places. And so not creating that uncertainty and not creating those inefficiencies is in everyone's interest.
Right. I'm of the opinion, I mean, we do have some cash in the portfolios, but I'm on the hold side. I invest for clients. I can invest for myself. Any thoughts on that?
I think it's very hard to have strong clarity around any specific stock right now. I think investing in the U.S. stock market has been a very strong strategy for a very long time if you're able to hold. I believe having a diversified portfolio, as most I'm sure you preach, is a wise strategy, especially if you can rotate into stocks that retain value under stressful times. I also think dividends, especially a dividend portfolio, and then looking at other ways to mitigate potential short-term downfalls, such as holding different currencies or holding a portfolio of European stocks or Japanese, however you like to diversify. I think those would be reasonable ways to weather what is clearly a volatile historic event.
Right. I watch the Mets, right? I'm like an avid Met fan through since I'm 5, right? So, I mean, the Super 8 film of the 1969 World Series that my parents showed at my birthday party when I was 7. We're going to know a lot more when we hit the midterm elections.
We will know a lot more when we hit the midterm elections. I think Wisconsin was a strong indicator. I think the polls that are coming out are another strong indicator. I believe there's a very strong contingency that is ignoring the information that's coming out right now. They'll just pursue their support of the Trump administration. But I think there's a larger set of people, both independents, moderate Republicans, and so forth, that are seeing that what they thought would happen is not being implemented or executed in a way that they feel is going to reach the objectives that the Trump administration professed in the campaign.
Well, it's crazy that the long term is a year and a half or 2 years, right?
Well, that's the beauty of politics, right?
I like that. We're going to leave it at this.
All right. Well, speaking with you.
I can't thank you enough.
Well, thank you for having me. This was
Professor Sharon O'Halloran, thank you very much.
Thank you, Aaron. Bye-bye.
Aaron Schindler is a certified financial planner with Osaic Wealth. He can be contacted at aschindler@osaicwealth.com if you have any questions about today's episode. Aaron specializes in wealth building and asset protection strategies for individuals, families, and small businesses, with an emphasis on investment management, long-term care, and legacy planning. Unlike some financial advisors, he directly manages most of his clients' investment portfolios rather than outsourcing this important aspect of financial planning. Aaron tirelessly works with clients to determine their investment and retirement goals, as well as their current or future income needs, risk profiles, and allocation models. After which, he customizes and designs portfolios that strive for below-average risk while striving to achieve their target returns. As a graduate with a BA at Columbia, Aaron focuses on the political economic roots of the fall of democracies and the rise of bureaucratic military governments in Argentina, Uruguay, and the rest of the Southern Cone in the 1970s. He continues to apply his knowledge to today's world choices, and was delighted to have Sharon O'Halloran join him today. Sharyn O'Halloran is the George Blumenthal Professor of Political Economy and International and Public Affairs at Columbia University. She's also a research associate at the Central Bank of Ireland. Previously, she served as Senior Vice Dean and Chief Academic Officer of the School of Professional Studies and chaired the University Senate. Dr. O'Halloran has authored over 60 articles and 4 books, including Politics, Policy, and American Trade Policy, and After the Crash, Financial Crisis and Regulatory Responses. Her most recent research, published in Frontiers of Artificial Intelligence, leverages AI to assess the impact of financial regulations on systemic risk. O'Halloran received a BA in Economics and Political Science, MA and PhD from the University of California, San Diego. She also holds an MS in Enterprise Risk Management from Columbia University. Securities and advisory services offered through Osaic Wealth, Inc., member FINRA SIPC. Osaic Wealth is separately owned, and other entities and/or marketing names, products, or services referenced here are independent of Osaic Wealth.